Why did your bank balance stay identical while your monthly grocery bill doubled since 2020? While most families watch their hard-earned rupees stretch thinner, a quiet group grows wealthier. During the 2008 market crash, smart investors made 34% returns without touching risky stocks. Their secret was holding two specific protective assets that thrive when paper currency struggles. Understanding this simple strategy reveals why keeping pure cash is a hidden risk. In 2024, keeping 100% of your wealth in liquid rupees feels safe, but it traps your future. We were raised to believe that savings accounts offer complete security for our families. Cash is vital for emergency spending, but liquid money constantly loses its purchasing power. When paper currency sits idle, invisible economic forces slowly drain its real market value. Let us examine how consumer prices quietly melt your savings like ice under the sun. A lunch that cost 100 rupees a few years ago now requires nearly double that amount today. Because retail inflation averages 6% annually, every idle rupee loses half its power over time. Holding paper money is like holding ice. It quietly melts away without you noticing. Your account balance shows the same figures, but your shopping basket holds far fewer items. Many rely on bank fixed deposits, but those returns often fail to beat real inflation. A 7% bank fixed deposit looks attractive until income tax reduces your yield below 5%. When real inflation runs at 6%, your net purchasing power shrinks despite earning interest. Focusing only on guaranteed returns creates a false sense of long-term financial security. If your experience matches this, share your insights in the comments and subscribe for more. The underlying cause goes beyond local banks to how central systems print currency. Global money supply expanded by trillions after 2020, diluting the value of existing cash. Imagine slicing a single pizza into 16 smaller slices instead of 8 equal pieces. The total food remains unchanged, but each individual slice becomes significantly smaller. When central banks print extra notes, every single rupee in your pocket buys less. This currency dilution creates immediate ripples across global foreign exchange rates. In 2024, the US dollar crossed 83 rupees, marking a long-term currency shift. A weaker rupee makes imported electronics, crude oil, and foreign travel far more expensive. Even if you stay in India, global supply chains pass these higher costs directly to you. Without international asset protection, household budgets face pressure from abroad. This pressure hits hardest when families face major overseas expenses like education. Paying for a university tuition in 2024 requires 15% more rupees than it did 2 years ago. Parents who saved dutifully in cash suddenly find their education funds falling short. Relying solely on local paper money leaves family dreams exposed to global swings. To protect against currency drops, world-class investors rely on timeless reserves. That brings us directly to the ultimate financial shield used throughout history. For over 3,000 years, gold has preserved purchasing power while currencies collapsed. Unlike paper money, no government or central bank can print gold out of thin air. During Dhanteras and Diwali, Indian households intuitively honor gold as real wealth. Gold is unprintable money that maintains its purchasing strength across generations. Iconic Indian industrialists understood this capital defense strategy deeply. Visionaries like Ratan Tata built global empires by prioritizing safety over reckless growth. Ratan Tata famously emphasized that surviving economic storms comes before expansion. Mukesh Ambani similarly balances massive investments with robust treasury cash shields. True financial strength means securing your core assets before chasing speculative returns. Think of gold not as a fast scheme, but as household emergency equipment. Gold is like a home fire extinguisher. You do not buy it to generate monthly income. It sits quietly on the wall during peaceful times, looking completely unexciting. When economic fires strike, that single protective asset preserves your portfolio. Viewing bullion as insurance prevents panic selling during routine market upturns. This exact logic explains why central banks are purchasing physical bullion today. In 2023 alone, global central banks purchased over 1,000 tons of physical gold bullion. The Reserve Bank of India steadily increased gold reserves to hedge against global shocks. Because central banks manage national survival, their steady buying reveals true risk. When institutional guardians back their balance sheets with gold, retail investors should listen. For Indian investors, holding gold yields a double benefit during market downturns. Because gold trades internationally in US dollars, Indian gold holders enjoy a dual benefit. When international gold prices rise and the dollar gains against rupees, gains compound. This double boost turned gold into a top-performing asset in rupees since 2020. Understanding this connection brings us to our second protective asset class. Let us see why global capital rushes toward hard currencies during times of shock. Over 85% of international trade settlements take place in US dollars every single day. When global markets panic, capital flees emerging economies toward reserve assets. The US dollar acts as a sturdy shelter during intense international economic storms. Holding dollar-denominated assets gives your portfolio a powerful defensive cushion. This cushion becomes crucial when domestic stock markets experience sharp crashes. When the Nifty drops 20% during a crisis, the US dollar typically surges higher. Investors holding global equity ETFs saw currency gains offset domestic stock losses. Instead of suffering deep portfolio cuts, their defensive holdings stabilized total wealth. This inverse relationship protects your family when market panic strikes suddenly. However, even precious metals come with risks every investor must evaluate carefully. Gold is not a risk-free rocket. Prices stagnated between 2013 and 2018 in global markets. Precious metals generate no corporate dividends or quarterly bank interest yields. Buying gold at record peak highs can lead to years of flat portfolio returns. Treating defensive assets like fast speculative bets usually leads to painful disappointment. Smart wealth management requires striking a healthy balance across all asset classes. Putting 100% of your net worth into gold or dollars creates new financial imbalances. Equities build long-term wealth, while gold and cash reserves protect your foundation. Financial advisors often recommend keeping 10% to 15% in defensive assets. This balanced setup ensures growth during booms and safety during market panics. Let us examine the most tax-efficient routes available for Indian investors today. In India, sovereign gold bonds offer 2.5% annual interest alongside tax-free capital gains. Gold ETFs and mutual funds provide instant liquidity without physical storage risks. For dollar exposure, US index funds offer simple international diversification from home. Choosing regulated digital routes saves high making charges associated with physical jewelry. The key to success is adopting a disciplined strategy instead of large lump sum bets. Allocating a fixed monthly amount eliminates market timing anxiety and smooths purchase costs. When gold prices dip, your systematic investment purchases more units automatically. When exchange rates rise, your existing foreign holdings quietly cushion your total wealth. Consistency over months builds an indestructible financial fortress for your loved ones. This disciplined habit turns volatility into a reliable partner for family security. True financial peace comes from knowing market headlines cannot shatter your family savings. Cash keeps daily life moving, but gold and hard assets protect your future buying power. Balancing growth investments with defensive reserves ensures long-term household stability. That is why the practice of holding gold reserves remains relevant in modern financial planning. Building your family wealth shield starts before the next global crisis headline hits. Economic cycles come and go, but disciplined preparation stands the test of time. By securing protective assets today, you shift from worrying about crises to navigating them. Focus on preserving what you earn before chasing the next popular investment trend. Start small, stay consistent, and take control of your financial destiny today. The choices you make quietly today will shape your financial strength for years to come.